I could have doubled my wealth if I hadn't made one boneheaded mistake 50 years back. That's not dramatics, it's just arithmetic. Compounding works both directions, on your gains and on your stupidity. Now let me tell you something uncomfortable. By 50, most of your big moves are behind you. Your career arc is locked in. Your family situation is what it is. And your capacity for wild risk-taking, gone. Unless you enjoy gambling your retirement, which has about as much sense as betting your house on red. The truth is elementary. After 50, you don't need brilliance. You need to sidestep disaster. People love yakking about finding the next Tesla or striking it rich in crypto. That's just static. At 50, survival becomes the game. I came up during the Depression, watched plenty of folks lose everything, not for lack of intelligence, but because they borrowed too much, trusted the wrong people, or believed the good times would roll forever. Same pattern repeats every generation. Different faces, identical stupidity. Here's my number one investment rule past 50. Play defense, not offense. You already had your offensive years. 20s, 30s, maybe 40s. That's when risk could pay because you had runway to recover. At 50, time stops being your ally. Most people miss this. They hit midlife thinking they're supposed to catch up, so they pile into some hot stock or get-rich-quick scheme. What happens? They crater faster than you can say retirement plan. Let me illustrate. I knew a fellow once, very bright, Ivy League, successful career. At 55, he decided he was falling behind his peers, dumped a fortune into dot-com startups in the late 90s. By 2002, he had less than half left, spent the rest of his life talking about what he almost had, complete waste of brains and capital. The irony, if he just parked his money in dull, dependable businesses, Coca-Cola, Procter & Gamble, Johnson & Johnson, he would have been perfectly fine. Not glamorous, not exciting, but fine. Sometimes fine is all you need. People past 50 forget the real enemy isn't underperformance, it's catastrophe. Losing half your money at 60 isn't the same as losing half at 30. At 30, you've got 3 decades to recover. At 60, you might not live another 30 years. Not a cheerful thought, but it's arithmetic. You've got to shift from trying to be clever to trying not to be stupid. And believe me, avoiding stupidity is a full-time occupation. So if you're past 50, forget chasing unicorns. Forget trying to be the smartest fellow in the room. The smartest guy in the room usually ends up broke, divorced, or both. Your objective now is durability, staying power, having enough to outlive your mistakes. I often say, all I want to know is where I'm going to die, so I'll never go there. For investing after 50, all you need to know is what'll wipe you out. Then don't go there. That means avoid leverage. Debt is poison, especially when you lack decades to repay it. Avoid speculation. You're not going to outtrade some 25-year-old with 6 screens and no personal life. Avoid complexity. The more convoluted the deal, the higher the odds you're the patsy. At 50, your best move is keeping things boring. Boring works. Boring compounds. Boring lets you sleep at night. The financial world doesn't reward excitement, it punishes it. Here's the paradox. The duller your investments after 50, the more thrilling your retirement. Don't aim to get rich quick. Aim not to die poor. Envy has destroyed more portfolios than recessions ever did. People don't go broke because they can't earn. They go broke because they can't stomach watching somebody else earn more. I've called envy the stupidest of the 7 deadly sins, and I meant it. Why? Because it's the only one where you get zero pleasure. Greed, you get to spend. Gluttony, you get to eat. Lust, at least there's some enjoyment. But envy, you just sit there stewing in bitterness while the other fellow's off enjoying his yacht. It's contagious too. Your neighbor buys a fancy car, suddenly you think you need one. Your brother-in-law brags about a 10-bagger. Suddenly your steady compounding looks like failure. That's when trouble starts. Let me give you an example. In the 90s, Warren and I owned boring businesses. Insurance, candy, furniture stores, newspapers, nothing flashy. Meanwhile, Silicon Valley kids half our age were minting billions out of thin air. We looked like fossils. Until the bubble burst in 2000. Same people who laughed at our slow motion approach were suddenly broke. We were still wealthy. Here's the lesson. The game isn't beating others. It's not losing yourself. Envy makes you forget that. I knew a man who invested reasonably well, steady returns, decent savings. Then his golf buddies got rich in oil stocks. He couldn't stand being the small-timer, leveraged up, chased the same trades. When oil collapsed, so did his portfolio. His buddies lost money too, but they still had their careers. He had retirement to worry about. Past 50, envy is lethal. You don't have time to rebuild from your own stupidity. One envious move can erase decades of patience. The best investors I've known had virtually zero concern for what others were doing. Didn't care if their neighbor bragged about a hot stock. Didn't care if CNBC screamed about the next big thing. They cared about staying solvent and compounding quietly. The irony is, if you want a contented old age, you should root for your friends to succeed. Envy makes you miserable when others do well. Terrible way to live. Imagine being 80 and still bitter someone else had a bigger house. What a waste of a life. I've outlived plenty of people who were richer than me at various points. Never envied them. I knew most were playing games they couldn't win long term. Sure enough, they burned out, their money evaporated, or they drank themselves to death. Meanwhile, I stayed boring, rational, and alive. So if you're past 50, here's advice you can bank on. Stop caring what anyone else earns. Stop measuring your life against your neighbor's portfolio. Stop scrolling through financial gossip like it matters. Envy won't make you richer, won't make you smarter, won't even motivate you. It'll just push you into stupid decisions. Remember, your retirement doesn't care if someone else made more. Your family doesn't care. The grocery store doesn't care. Only your ego cares. And your ego has bankrupted more investors than any bear market ever did. Envy isn't just a sin, it's a bad investment strategy. Don't play it. I don't enjoy discussing my mistakes, but they're more useful to you than my successes. Everyone loves hearing about the winners. Few stop to examine the losers. That's where the real lessons hide. Here's one of mine. Decades back, I bought into a company without truly understanding its future. On paper, looked cheap. Numbers were clean, management seemed competent. But I didn't think deeply enough about the business model. The result, made a quick profit but sold too soon. If I'd had the patience and insight to hold, that position could have doubled my net worth. That's not hyperbole, it's mathematics. Compounding doesn't forgive early exits. The mistake wasn't the investment, it was me. I lacked the discipline to stick with a truly great business, settled for being right short-term instead of being rich long-term. Most investors do the same. Sell winners too soon, cling to losers too long. It's backward. You should do the opposite, but it's hard. Human nature pulls you the wrong way. People crave certainty. When something rises, they want to lock in gains, feel safe. But selling Coca-Cola after a modest gain in the 70s wasn't safe. It was foolish that stock kept compounding for decades. Anyone who sold early was congratulating themselves while quietly robbing their future self. I don't beat myself up about it anymore. Regrets wasted energy. But I do use the memory to remind myself of one simple rule. If you find a truly great business, sit on your ass and hold it. Don't get clever, don't get itchy fingers. The world constantly tempts you to do something. Turn on the news. You'll see endless reasons to act. Elections, wars, inflation, recessions. But most of that's noise. Good businesses survive. Great businesses thrive. Your job isn't outguessing every headline. It's avoiding selling the goose that lays golden eggs. For people past 50, this lesson matters even more. You don't have the luxury of making a mistake and waiting 40 years for compounding to bail you out. One wrong exit, one badly timed clever move can permanently shrink your nest egg. I see it constantly. Someone holds a reliable dividend payer for decades. Then they read a newsletter about some disruptor and decide to rotate out, dump Johnson & Johnson and chase a tech IPO. Few years later, they're wondering why their income dried up and their accounts bleeding. The mistake isn't failing to predict the future. Nobody can. The mistake is abandoning what works in pursuit of what excites you. Excitement is a terrible investment strategy. I could have been richer if I'd learned this earlier, but at least I learned it. Many never do. They spend entire lives hopping from one opportunity to the next while the boring investor next door quietly builds real wealth. So here's the takeaway. It's not brilliance that makes you rich. It's endurance, the ability to hold on when everything tempts you to let go. If you're past 50, you can't afford to repeat my mistake. When you find a business that'll still be making money 20 years from now, hold it. Sit still. Don't sabotage yourself by being clever. In the end, the market rewards the patient, not the excitable. I became wealthy by being consistently not stupid, not by chasing brilliance. The older I get, the more I realize this. Most people are far too certain of themselves. The market punishes that arrogance sooner or later. I've watched it for nearly a century. In the 30s, people were certain prosperity would never return. They hoarded cash and missed the rebound. In the 60s, everyone was sure America's big companies would always compound at high rates. They ignored valuations and got crushed in the 70s. In the 2000s, investors thought tech stocks only went up. We all know how that ended. Confidence feels good, but it's not correlated with accuracy. In fact, I've observed the opposite. People who sounded most certain usually lost the most money. Here's reality. The world's too complex for you to know everything. You don't get rich by being a know-it-all. You get rich by knowing what you don't know and avoiding it. When Warren and I built Berkshire, we passed on thousands of opportunities. Didn't understand them, so we ignored them. And guess what? We didn't miss much. The world throws plenty of pitches. You don't have to swing at everyone. But most investors can't resist. They think having an opinion on everything makes them smart. They'll tell you where oil's headed, what interest rates will be next year, how some new startup will revolutionize everything. What they don't tell you, 90% of those opinions will be wrong. Past 50, this flaw becomes more dangerous. You don't have the same margin for error as a young gambler. If you throw money behind your half-baked opinion, the market won't forgive you. And unlike at 30, you don't get another 30 years to rebuild. I watched a successful Los Angeles lawyer once, sharp fellow, good income, decide he was also a currency expert, read a few articles, formed an opinion, bet heavily against the yen, wiped out most of his retirement savings. Not because the yen was predictable, that's obvious, but because he was too confident in his ability to predict it. The irony, if he'd admitted, "I don't know," and left his money in something boring, he would have been fine. But people would rather be wrong loudly than silent wisely. Here's what I recommend. Develop the courage to say, "I don't know." It's a rare and valuable trait. If you can admit ignorance, you won't bet on nonsense. You'll stick to areas where you actually have competence. That's what we did at Berkshire. We understood insurance. We understood Coca-Cola. We understood See's candies. So we bought them. We didn't understand airlines or dot-com stocks, so we left them alone. That one habit saved us from disaster more times than I can count. Overconfidence kills more investors than recessions. It's not the market that ruins you. It's your illusion of knowing more than you do. So if you're past 50, listen carefully. Stop acting like an oracle. You don't need opinions about every sector, every trend, every country. You only need to know a few things well and admit you know nothing about the rest. In fact, I'd go further. The more certain someone sounds about the future, the faster you should run. The world's full of people eager to sell you certainty. Analysts, pundits, salesmen, they all sound smart, but none of them will pay your bills when their certainty blows up your portfolio. So next time you feel the itch to predict the unpredictable, stop and ask, what if I just don't know? That question may save your retirement. One of the biggest divides I've seen in life is between people who think like employees and people who think like owners. Has nothing to do with job titles or paychecks. It's about mindset. Most people, even very smart ones, spend their lives playing career games. They optimize for promotions, titles, perks, spend years currying favor with bosses they don't respect Polish resumes instead of building wealth. That's careerism, and it's a trap. I've said many times, The world isn't driven by greed, it's driven by envy. Careerism feeds on that. You watch the guy next to you get a fancier title, suddenly you want one too. But titles don't compound, ownership does. When Warren and I built Berkshire, we didn't care about looking important. We cared about owning things that made money while we slept. See's Candies, Coca-Cola, insurance companies. They didn't care whether we were vice president of this or senior partner of that. They just sent us checks. Meanwhile, I watched brilliant lawyers, bankers, executives waste decades climbing ladders. They earned high incomes, but owned nothing that worked for them. The minute they stopped showing up, the money stopped too. That's not wealth. That's just a high-class treadmill. Let me give you an example. Back in my law days, I worked alongside some of the sharpest minds you could imagine. Billed clients by the hour, made a fortune, thought they were kings. But if they dropped dead, their income dropped dead too. They owned nothing scalable, nothing durable. They were rich employees, not owners. By contrast, Warren and I channeled our time into building ownership. We wanted businesses that didn't depend on our presence every day. That way, even if we were golfing or dead, the assets kept compounding. That's the difference. If you're past 50, this lesson matters more than ever. You don't have time to keep trading hours for dollars. Eventually, your energy runs out, your health falters, the treadmill stops. So ask yourself, do you own anything that works for you when you're not working? Real estate that pays rent, stocks that pay dividends, a business stake that keeps earning whether you show up or not? If the answer's no, you're not really investing. You're just extending your career under another name. Careerism also clouds judgment. Employees think about pleasing bosses. Owners think about surviving reality. That's a massive difference. A careerist lawyer will do whatever makes a partner happy. An owner asks, does this make money long term? Only one of those questions compounds. I'll tell you something harsh. If you're past 50 and still living paycheck to paycheck, no matter how high that paycheck, you've probably been thinking like a careerist too long. You've optimized for the wrong game. Good news, you can still shift. Stop caring about titles. Stop caring what colleagues think. Care about ownership. That doesn't mean quitting your job tomorrow. It means redirecting your energy and capital into assets that outlast you. Buy boring, durable businesses. Live below your means. Build ownership stakes instead of wasting money trying to look successful. It's a quieter game. Nobody claps when you buy shares of Procter & Gamble. But in 20 years, those shares will be paying you when the applause has long faded. Careerism fades. Ownership compounds. Pick the one that'll still matter when you're 70. If you live through the Depression, you never really forget it. I was born in 1924. By the time I was a boy, the economy had collapsed. Banks failed. Businesses folded. Families went hungry. People today think volatility is when the stock market drops 10%. In 1932, the market had fallen almost 90% from its peak. That wasn't volatility. That was financial annihilation. I watched grown men lose their livelihoods, saw families move in together because they couldn't afford rent. My own family knew what it meant to cut corners and stretch every dollar. It was grim, and it left a permanent mark on how I see risk. Biggest lesson, you can't count on good times lasting forever. People today forget that. They think prosperity's the default setting. It isn't. Civilizations rise and fall. Economies swing between feast and famine. Live long enough, you'll see both. The Depression taught me to respect reality. Optimism is fine. Blind optimism kills. Plenty of people in the 20s thought the good times would never end. They borrowed money, speculated wildly, leveraged themselves into oblivion. When the crash came, debt destroyed them. That's why I've always despised debt. It makes you fragile. With no debt, you can survive bad times. With debt, bad times kill you. Another lesson, resilience beats brilliance. I saw small, boring businesses survive the Depression by being frugal and adaptable. Meanwhile, fancy operators with clever schemes vanished overnight. The survivors weren't geniuses. They were simply durable. That's a lesson most investors still don't get. Everyone wants to be clever. Nobody wants to be durable. Yet durability is what gets you through a once-in-a-lifetime collapse. I carry those lessons into my investing career. I don't try to predict recessions. Nobody can. What I do is assume they'll come eventually and prepare accordingly. That means keeping a margin of safety. That means avoiding leverage. That means owning businesses that sell products people will keep buying in good times and bad, like candy, soda, insurance. People mocked us for buying See's candies. How much money can you make selling chocolates? They laughed. Turns out people eat chocolate in recessions too. They eat more of it. In fact, it survived downturns that crushed flashier businesses. That's the kind of lesson you learn only after seeing true hardship. Now, if you're past 50, remember this above all. You don't get a second depression to relearn the lesson. If you blow up your finances once, you won't live long enough to rebuild. That's why you must structure your portfolio for resilience, not fantasy. When you hear people brag about how much leverage they're using or how brilliant their trading strategy is, remember 1932. Remember breadlines. Remember men who thought they were smart, suddenly standing in soup kitchens. The world has changed since then. Human nature hasn't. People still get greedy, still take on too much debt, still assume good times will roll forever, and every few decades reality slaps them in the face. So my advice is simple. Learn from history you didn't live through. You don't need another depression to understand the danger of stupidity. All you need is humility and memory. If I had to reduce my so-called success to 3 habits, it'd be this. I avoided debt, I avoided drama, and I avoided dumb people. That's it. No magic formulas, no secret sauce, just subtraction. Let's start with debt. I've said it before. Debt is poison. It destroys discipline, magnifies stupidity, and guarantees that when bad times come, and they always come, you're first to get wiped out. I watched people in the 30s borrow against their homes, thinking they were safe. When the crash came, they lost everything. That image stuck with me. Warren and I built Berkshire without leaning on borrowed money. We could have juiced returns with leverage, sure, but 1 or 2 wrong bets involving debt. We'd be broke like everyone else. Staying solvent was more important than looking clever. If you're past 50, debt is lethal. At 30, maybe you recover. At 60, it's game over. You won't live long enough for compounding to save you. Now, drama, I don't tolerate it. I avoided unnecessary fights, pointless feuds, people who seemed addicted to chaos. Drama wastes energy that could be spent thinking clearly, building patiently, or enjoying life. Plenty of smart men have been ruined not by bad investments, but by bad divorces, bad partnerships, bad temper. You can be brilliant in finance and still bankrupt yourself with personal chaos. I wasn't interested. Then there are dumb people. And by dumb, I don't just mean low IQ. I mean people who are reckless, dishonest, unreliable, or addicted to shortcuts. They're radioactive. Their stupidity spreads. Hang around them long enough, you'll get caught in the fallout. Early in my career, I saw colleagues fall in with slick operators who promised big returns. Pattern was always the same. Fast talk, shady deals, inevitable collapse. The smart colleagues ended up dragged down simply by association. I made it a rule. Better to have fewer friends and partners, but high-quality ones. My partnership with Warren worked for 50 years, not because we never disagreed, but because we shared the same principles: rationality, patience, honesty, no drama, no debt, no stupidity. That made us durable. Most people underestimate how much avoiding the wrong things matters. Everyone looks for the right stock, the right deal, the right opportunity. They ignore the fact that saying no is more important than saying yes. One yes can make you money. One wrong yes can ruin you forever. If you're past 50, this isn't optional. You can't afford to waste years untangling from bad decisions. The margin for error is gone. So cut ruthlessly. No debt, no drama, no dumb people. It sounds harsh, but it buys peace of mind. And peace of mind is worth more than squeezing out a few extra percentage points of return. Remember, wealth isn't built by brilliance. It's preserved by discipline. And most discipline is just the ability to walk away from stupid temptations. People love to romanticize my partnership with Warren. They think we sat in some ivory tower playing chess with billions, always in agreement, always brilliant. That's nonsense. What actually worked wasn't magic. It was discipline, temperament, and compatibility. And what didn't work? Well, we made our share of blunders, fewer than most. But still, here's what worked first. We trusted each other completely. No backstabbing, no politics, no jealousy. That's rare in business. I didn't wake up worrying Warren was scheming against me. He knew the same about me. That trust gave us enormous efficiency. Most organizations waste half their energy on internal nonsense. We didn't. We also thought the same way about money. Both valued patience, rationality, independence. Neither of us cared about looking fashionable or chasing Wall Street's approval. If something didn't make sense, we didn't touch it, no matter how many people mocked us. Another thing that worked, our complementary skills. Warren was a genius at spotting undervalued businesses. I was better at reminding him not to get seduced by cigar butts, those crummy little companies you buy cheap and sell for a small profit. Together, we aimed higher. We bought quality businesses at fair prices and held them. That shift was worth billions. Now, what didn't work? Well, for one, we weren't perfect judges of people. We occasionally backed managers who turned out to be crooks, fools, or both. You can't screen for every human weakness, but it annoyed us. Character matters. When we got it wrong, it cost us. We also underestimated how hard it is to change human behavior. Some companies look fixable on paper, better management, better incentives, maybe a turnaround. But you don't change corporate culture easily. If the DNA is rotten, new wallpaper won't help. We learned that the hard way. And yes, we missed opportunities. People think Berkshire grabbed everything good. Wrong. We passed on things that in hindsight would have been spectacular. Tech companies, for instance. Warren admitted he didn't understand them well enough. Neither did I. In that sense, our caution cost us upside. But I'll tell you what, I'd rather miss upside than blow up chasing what I don't understand. That caution may have cost us billions, but it saved us from disasters that would have cost more. Our biggest strength was knowing the limits of our knowledge. Most investors don't have that. They want to be experts on everything. We didn't. We stuck to our circle of competence. If it was outside, we just said no. That simple habit explains most of Berkshire's durability. If you're past 50, you should think about partnerships the way we did. Ask yourself, does this person make me more rational or less? Do they bring stability or drama? Do they amplify my strengths or magnify my weaknesses? The wrong partner can ruin decades of work. The right one can multiply it. In the end, what worked between Warren and me wasn't brilliance. It was compatibility. And what didn't work were the rare moments when we forgot our own rules. So don't mythologize us. We weren't gods. We were just two stubborn men who shared a brain when it came to money. And that was enough. Here's something most people don't want to hear. Getting rich after 50 is less about making brilliant moves and more about avoiding fatal ones. At that age, survival is the strategy. You can still build wealth after 50. I've seen plenty do it, but they didn't do it by chasing hot tips or trading like 20-year-olds. They did it by being boring, steady, and relentlessly rational. The surprising truth is this: you don't need to double your money overnight. You just need to not blow yourself up. Let me give you an example. I knew a doctor, good income, sensible spender. At 55, he started funneling his savings into a basket of high-quality dividend stocks. He ignored the noise, reinvested dividends, lived below his means. By 70, he wasn't spectacularly rich, but he was financially free. No debt, plenty of income, comfortable, secure. Now compare that to another man I knew, sharp entrepreneur who thought he was behind. At 52, he dumped his savings into speculative real estate deals, leveraged to the hilt. When the market turned, he was bankrupt by 57. The difference wasn't brains, it was discipline. Here's the paradox. At 50, you don't need brilliance to win. You just need to stop doing stupid things. And believe me, the world offers you an endless buffet of stupid things. Crypto scams, day trading fads, exotic real estate schemes. The list never ends. If you want to get rich or stay rich after 50, here are the rules. Keep it simple. Own businesses or assets you actually understand. If you can't explain it to your spouse in 1 minute, you probably shouldn't own it. Preserve capital. Every dollar you lose at 60 is far more expensive than every dollar you lose at 30. You don't have decades to recover. Avoid envy. Don't look at the guy who doubled his money in some risky bet. Most of the time, he won't keep it. Your job isn't to keep up, it's to stay standing. Play defense. A steady 7% compounded over 15 years is a miracle at 50. It doubles, then doubles again. By the time you're retired, you'll look rich to anyone who spent those same years chasing fads. Most people past 50 forget this. You don't have to be spectacular. You just have to be solvent. The world has a way of rewarding the ones who endure. The truth is, I didn't plan to become a billionaire. I just avoided stupidity long enough that compounding did the heavy lifting. I overshot. That's the game. So if you're past 50 and worried it's too late, stop panicking. You don't need to reinvent yourself. You don't need the next big thing. You need patience, simplicity, and durability. It's not glamorous advice, but it's the only advice that works. If you want one blunt truth to end on, here it is. If you're not spending less than you earn, nobody can help you. Not me, not Warren, not the smartest financial advisor on the planet. The laws of arithmetic don't care about your feelings. They don't care about your lifestyle. They don't care about your excuses. If more money flows out than flows in, the end result is guaranteed. You go broke. I've watched people with six-figure incomes live like paupers in old age because they couldn't resist spending everything they made. And I've watched modest earners die comfortable because they lived simply and invested consistently. It's not intelligence. It's not opportunity. It's behavior. Overspending is the fastest way to ruin any investment plan. Doesn't matter if you're 25 or 65. If you keep digging the hole deeper, compounding works against you. Not for you. People ask me all the time, Charlie, what's the best investment at my age? My answer is usually, stop buying crap you don't need. That advice alone would solve half the financial misery in the world. Past 50, the consequences are sharper. You don't get to make infinite mistakes. You don't get to start over every decade. Your choices either set you up for a dignified retirement or they set you up to depend on others. The goal at this stage isn't glamour. It isn't chasing the biggest return. It's dignity. It's independence. It's knowing you won't have to beg your kids for money or work until you drop dead. And that doesn't come from clever trades. It comes from restraint. If you cut out debt, avoid drama, ignore dumb people, and live below your means, you've already beaten 90% of humanity at the money game. Do that long enough and compounding will handle the rest. But if you overspend, forget it. Nobody can save you, not even the stock market gods. So here's my final question. When you're 70, do you want to be envying your neighbor's toys or enjoying your own freedom? The choice is obvious. The execution is rare. Remember, the world doesn't reward brilliance nearly as much as it rewards avoiding stupidity, and nothing is more stupid than spending yourself into misery. That's all there is to it.